All right, let's go ahead and get started. Today is Monday, April 22nd, 2 p.m. section. Recording being done. Here is the sign-in sheet. Make sure you sign this today. For many of you, 2 weeks from today will be your last day of class. Okay, so we're quickly approaching the end of the semester, and we don't really have as much content to do. We kind of covered all the content, so we're just kind of doing some of these exercises and kind of wrapping things up in an application. Right? So I do want to talk about a few end of semester things. So on assignments, so we approach the end of semester. First thing is that there will be another essentially extra credit assignment, homework 13, due a week from today. It'll be the final individual assignment of the semester. And again, a word about the extra credit. So extra credit doesn't mean you don't have to do it. Extra credit means that we're now past 100 points for the semester, and these last two assignments are adding 5 points to your semester grade. Okay? So the idea is that ELMS is going to start confusing you about your grading, because ELMS was never designed to have more than 100 points in a semester. Okay? And so basically what's going to happen for your final grades is I'm going to download the grade book and add up all the points across all the assignments, and you'll need 90 total points out of 106, I believe we'll have, to basically make an A minus. Okay? And you'll need 93 points out of 106 to make an A. Right? So it's total points across all grades. The individual grade and assignment doesn't really matter, and ELMS is going to show you a percentage of total, which is going to be confusing for a letter grade, and I don't use that. So warning you about that. But nonetheless, if you're interested in extra credit, this is it. I'm not giving any more. So semester ends, you're not happy with your grade, you're like, can I have extra credit? This was your chance. So make sure you do these assignments. Okay? Yes?
You still have to do it to opt out the final?
Yes, you do.
Oh.
Mm-hmm.
What about the assignment replacement?
So that's, I'm going to come to the assignment replacement. So that's a good point. All right, so that's next Monday. Final individual assignment, final extra credit opportunity for the semester. Make sure you do that. Okay? Now, May 2nd, which is 2 weeks from Wednesday. Okay? A couple things are going to happen. First, the Bloomberg Trading Challenge ends on May 2nd, Wednesday, May 2nd. Okay, so that's quickly coming to an end. Less than 2 weeks away. The other thing that's going to matter is the assignment replacement is due end of day, May 2nd. Anytime between now and then, if you haven't done it already, you can write the 500-word minimum paper for the assignment replacement and submit it. Assuming you do that, okay, that assignment replacement can replace any individual assignment, which means the Bloomberg trading or the Bloomberg certification, so you didn't do it, I think everybody did it, or any of the 13 homework assignments. The assignment replacement does not replace a midterm, and it doesn't replace a group project. Okay? So, but here's the point. Let's say that you didn't do homework 12. Didn't even turn it in. Okay? Got a 0. Right? So if you do the assignment replacement, we'll treat it as if you did it. You did 2 points, and there was no penalty for not submitting the assignment. Okay, so that's what the replacement will do. They replace 1. Okay? Now, you don't tell us what you want to replace. The TAs are actually going to do the replacement after you submit this on May 2nd. So between May 2nd and May 6th, the TAs will do the assignment replacement. They're going to look at all your individual grades. They're going to look at the 0 first, replace that, and then anything else that has a big impact, they'll then replace next. Yes?
You said it won't count for the trading challenge, right?
It does not count towards the trading challenge. Your opportunity, if you did poorly in the trading challenge, are these other extra credits. Okay? So that's the point. I got a 1 out of 5 for trading challenge, but I could actually make it up because there's 5 extra credit points. So, yes. Question?
If we missed the peer review, we also should use the...
Well, I was going to get to that next, exactly. So the other opportunity for assignment replacement is, let's say you forgot to turn in the peer review on time. Okay, you got a -1. All right, so assuming you didn't have any other challenges, assignment replacement, we'll change that to a 0 as if you turned it in, and it won't affect your ability to opt out to the final. Okay. So the reason why they're going to do the assignment replacement then is that Monday, May 6th, I believe. Yes, Monday, May 6th. Couple things. Your final presentations will be delivered on the 4th group case on multiples on Monday, May 6th. Okay? So again, the way I'm going to handle the multiples, I'll preview it right now, is what industry did you guys have for your valuation projects? Your tech? All right. So you're going to take your tech company, all right, Meta, for example, and you're going to pick 2 publicly traded peers, and you're going to do your multiple analysis on Meta plus the 2 peers that you choose. So each of you will choose 2 peers in your industry, and you'll decide who the peers are, and you'll decide the analysis and explain that, premium or discount, similar to your assignments. You do that as a 10-minute PowerPoint, and you'll do that on Monday, May 6th. All right? But at the same time, peer reviews are due that day. Okay? And that's important because what we're also going to tell you on probably sometime May 6th is that, because I'll quickly put the grades in, but whether you're able to opt out of the final exam. Okay? So that late in the day, Monday, May 6th, or maybe even early in the day, Tuesday, May 7th, there's an assignment here called Final Exam Opt-Out. We'll make an announcement to check that assignment. If you're able to opt out of the final exam, you'll see 10 points in that final exam opt-out. If you see 0, that means you got to take the final exam, and the final exam will be on Wednesday, May 8th. Okay, so that's going to be essentially the last day of class. We're not going to use the university exam period. We're going to use the last day of class. So if you opt out of the final exam, Monday, May 6th is your final day of class. Okay? If you don't opt out of the final exam, you'll take the exam during class time, unless you have an accommodation, on Wednesday, May 8th. And it'll be very similar to the midterm. It'll be 10 multiple choice questions, different multiple choice, but basically you'll take it during your class time. And it'll be auto-scored by ELMS later that day, so that by Wednesday night, you'll see all the points for all your assignments. You'll kind of know your letter grade, and within 2 days, I'll post the letter grades to UMEC. Okay? But you'll know your letter grades before I even post them. Okay? So that's kind of where we are at the point of semester. A lot of things happening pretty quickly. Just wanted to give you a highlight of that. Questions about any of that? Yeah.
I didn't excuse absence, and the TA told me to hold on to the email that I sent. Is there
So
anything-
back to excused absences, like I said, when they apply the criteria, that'll be another criteria they apply. You have more than one unexcused absence, you can't opt out. Yes.
So the presentation's on the 6th, and then the reviews is due like 5 p.m. Can we submit the reviews at the day?
You consider in advance of that, because I'm just saying, like, if you're going to give a negative peer review, you kind of know going into the presentation that the person didn't fully participate, so you should submit it early. All right. The only reason why this one's faster is because I need to know if there's any negative peer reviews that affect the opt-outs. Because if you get negative peer reviewed in any assignment, you cannot opt out. All right. So that's the opt-out criteria. So you need to complete every individual assignment with at least a 50% score. That's the first criteria. And no missed assignments. All right. You have to have at least a 6 out of 10 on the midterm. On your group projects, the grades don't apply unless you've been peer reviewed on any group project. Then you can't opt out. If you've been sent to the Honor Council, you can't opt out. Okay. And I think those are the major criteria. Okay. So again, they'll apply that criteria and let you know if you can opt out on hopefully end of day, May 6th, early morning, May 7th. Okay. Any other questions? All right. So again, a lot happening. So let's do a quick check-in on the Bloomberg Trading Challenge for your section. So again, we got about 2 weeks left in that, actually more like 10 days. This is section 301. Let's see how we're doing. Okay. All right. Why do you have this much cash?
Oh, we're liquidating for earnings week.
You're what?
We're liquidating for earnings week, which is this week.
Okay. So you want to be disqualified. You were telling me I should just disqualify you now? So what's the rule? What's the rule for disqualification? Repeat it to me so I know you understand it. What's the rule of cash? What's the cash rule?
I think it was something like $3,000.
Every now and then? All times. So how can you liquidate for earnings week if the rule is to not have more than $300,000 worth of cash? Should I just disqualify your team right now? Would you like me to disqualify you? So you're going to buy something today,
Yeah.
right now, before the market closes. And if I check this tomorrow and I see above 300,000, you're getting a 0, and your entire team will not be able to opt out of the final exam, and I'm not going to allow you to make it up. Okay. All right. We have rules. Rules have to be followed. That's just one of the sticklers I told you about the first day of class. I'm a Martinet. I accept it full force. Yes.
Does the 50% rule about the assignments for the final opt-out also apply to the training challenge?
No. So the 50% minimum grade for individual assignments does not apply to the trading challenge because by design, half of you will get less than 50%. And so I don't feel that that's fair to you in this assignment. So the key is you have to participate in the assignment. So the team that gets disqualified tomorrow for non-participation, they will no longer be able to opt out of the final exam and they'll get a 0 on the assignment. But the rest of you that follow the rules, it doesn't matter what your grade is, you will still be able to opt out of the final exam. Okay, any other questions about that? Okay, so, and by the way, this would be the grading if the assignment closed today. I don't know what you did, K-Wang team, but no one else is making money in any of the other sections. You're the only team with a positive return, and you're making 19.5%, which is pretty darn impressive considering how bad the markets have been performing the last 4 weeks. Okay, it's really brutal out there in the real world, and it's hard to make money in a down market, which is one of the key parts of the trading challenge. You're making 19.5%. So, don't know what you're doing, but maybe we should all look at your portfolio after the semester's over. So, the other teams are losing money. A couple teams down 16%, down 13%. It's kind of tough out there. By the way, that's the other thing is you need 10 longs in the next 10 days. Okay, so if you don't have 10 longs, you also will be disqualified. So you got to do that. You got more time to do it, but you go buy something else. So there's the ranking in your section as of today. Any questions about the trading challenge? Other than how are they making 19.5%, which is a big outlier. All right. By the way, this week, 6 of the 7 largest tech stocks are reporting earnings. I think NVIDIA is next week. So essentially, opportunity there. Just letting you know. Whether they go up or down, some of these stocks are going to probably move. So something to think about because we're back in earnings season near the end of the semester, or the first quarter. Speaking of earnings, before we get into our topics today, what happened over the weekend with Tesla? Since we've been talking a lot about Tesla this semester. What's the latest Tesla news? Yes?
They do price cuts on it first.
So say more.
They're now decreasing their prices on Tesla vehicles because they have not been selling as much and they're trying to increase sales.
Yeah, they reported a drop in sales. I believe tomorrow they report earnings. Let's see. Let's check this. EVT is the event calendar. Their earnings call is the 23rd at 5:30. Today's what, the 22nd? So tomorrow, at end of trading day, they'll report their earnings, the earnings call right after that. And they've already told the market that their sales are going to be down. And the news that's going to come out tomorrow is they're likely to have an operating loss. First operating loss in a long time at Tesla. And the other thing is they got a lot of inventory. And so over the weekend, as he said, they slashed the prices on their cars to try and get rid of the inventory. They also slashed the price of their self-driving software. Self-driving software used to be $12,000. Now it's $8,000. Changed it over the weekend. And Musk was supposed to go to India this week to meet with the Indian Prime Minister about a launch of a new Tesla manufacturing facility in India. That all got postponed. They're not opening up the Indian plant anytime soon. So all of these signals that we've been seeing are getting worse and worse. That's why the stock's down 40%, by the way. Today it's down another $4. But if you look at the EEO for Tesla and you compare it even with 3 weeks ago, we did our assignment, these numbers are even lower. I mean, the analysts have slashed that revenue number on all of those out years dramatically over time, and the profits dramatically over time. And that's why you see, to some degree, the bear case is starting to become more realized than the bull case in the short term when you think about Tesla. right? And unfortunately, they're not doing anything that makes it better. I was actually telling the earlier sections that last week I had to do a quick trip to Durham, North Carolina. I was doing a section at Duke. And basically, I got there at like midnight Wednesday, and I came back afternoon Thursday. But the point is, I couldn't see ever in a Hertz rental car, and I didn't want an electric vehicle. Too much challenge, driving and get it charged. So traditional car. But when I got back on Thursday, it was daylight, and I was looking. They had about 40 electric vehicles cordoned off in long-term storage, collecting dust at the Raleigh-Durham Hertz Airport. And I think that was just, anecdotal, but it's another bad demand signal. Like, they're not even trying to rent those cars, right? And that's like $1 million of cash just sitting on a corner of a lot, underutilized. This is one of the reasons why Hertz is doing poorly, because they made a big bet that they'd rent out a bunch of EVs. It's been a disaster, and they're no longer buying the EVs. But that's the thing. It's not just the retail market. The wholesale market is really struggling for electric vehicles. And even the car renters are having trouble getting people to want to rent these damn things. So, again, not that we're not heading for an electric future, but that runway is looking longer and longer and much more challenging than what we thought even 6 months ago. And I think you're seeing that start to play out as the market starts to realize this in its adjusted expectations. And that's the real challenge of why the stock price looks like this. But at this point in the semester, this is 12 months worth of stock price, right? But that's why they're down almost 40%, right? Since July of last year when they peaked, right? But as I said, none of this should surprise any one of you at this point in the semester, all right? You should understand the dynamics of how everything we're talking about impacts the math, okay? They're going to have a lower G. They're going to have a lower spread, right? Their WACC is going to stay high. And that suggests lower multiples, lower valuations. All right, and you're seeing it play out in the marketplace. The other thing you're starting to see is more and more people are becoming less and less optimistic. In the buy, sell, hold opinions, 27 holds, 14 sells. Okay? That's not where Tesla was historically. They had a lot more buys and a lot fewer sells. All right? I'm not saying it's the whole market. There's still some bullish people on Tesla long term. But what I'm saying is the sentiment in general, and you can see the tracking of the sentiment by this line, has been coming down. Okay? Because basically people are getting more pessimistic in the real world about the future. Not saying it's right or wrong, but this is the view of the performance that the EIC is suggesting that Tesla's market is in. Okay? And their performance within the market. All right. Anybody want to add any questions, comments about this? Make sense? Yes, sir.
Is there anything that could come out in their earnings call tomorrow that could actually help them set the stock price?
Well, theoretically, Musk has been using the word robo-taxi a lot in the last week. And he announced that they're going to sell a robo-taxi come, I think, July, August of this year. And that is the potential, quote-unquote, bright spot that these robo-taxis might make the company more valuable. Okay? So people are going to be listening in on his view there. Okay? But I'll tell you that they actually have done a couple of robo-taxi experiments, one in Arizona and the other is currently happening in San Francisco. And if you remember the robo-taxi, I think in Arizona, the robo-taxi killed somebody. Like it ran him down and ran him over, right? And it was dangerous. And so they scaled it back. And so even the more leading states that were willing to take the tests for these robo-taxis have scaled down the ambitions because they're like, look, these cars are not fully safe, and they've restricted their ability to test them and roll out. So on the one hand, Musk is like, we're going to sell the robo-taxi that kills all robo-taxis in the future and makes this better. But I'm just saying, I think there's going to be some skepticism about whether the regulators are going to allow these things on the road until they're proven to be much more safe. And by the way, Tesla itself is under scrutiny for the self-driving software killing people. Because they basically said this software makes the car safer, and it's not making the car safer because people are basically relying on it, and it's actually flying off the side of the road and like crashing cars because they're not really made for true self-driving. And you're saying, we're going to solve the software that does this the next 3 months, announce it, and I'm just saying, yeah, maybe they do, but you got to be careful about whether this is marketing hype or this is reality. And that's what the market's going to start looking at very closely, I think, in the next couple of days. By the way, there's Cybertruck. Every one of those recalled for safety issues. I don't think that's helping their cause as well. Yes, sir.
Two things I saw. The Cybertruck, the fix,
Yeah.
the recall takes 35 seconds.
To fix it?
Yeah.
That's a good thing, but yeah. Still got to be fixed, though.
Yeah. And then also, my family friend had a Model X with about 800 miles on it. They were driving on the highway in the car. The sensors they started bugging out and took them straight into the wall.
Oh, he crashed the car?
The sensors crashed the car basically for him.
Was he okay?
Yeah, thankfully he's fine. But
That's good.
he said now they just have like a 800-mile Tesla.
Yeah, but I'm saying it's those real world data points. When he says like robotaxi, this is what people get nervous about. And by the way, the regulators are the most nervous about because they want to prevent people from being in those situations. And so the self-driving is not truly self-driving. I mean, it is within constraints, but you want to have a robotaxi where you're not in it, like that's a different type of story, especially if you're going to go nationwide. So I don't think anybody thinks that's turning it around in the short term, given all the other challenges. But that's part of the bull and bear. Yes, sir.
Do you think like Tesla and other like self-driving like pursuits are really limited just by like infrastructure though?
Limiting the infrastructure? Absolutely. Like for example, my BMW is self-driving. It's funny because I was driving some people. We went together to go do something in my car, and I was having the self-driving mode, and I didn't have my hands on the steering wheel or the gas pedal, and they were freaked out the whole time. They thought we were going to die. I was like, no, trust the car. It'll be fine. Okay, but how does self-driving work today? Basically, the cameras read the lines on the interstate, and it keeps you between the lines, and it reads the car in front of you to slow down or keep it up. That's basically what the self-driving does. What the self-driving is not as good at is exiting the interstate and going down other roads, particularly ones that aren't well marked, and that gets back to infrastructure. Like we need either sensors in roads, or we need really good lines on the roads for these cars to do true self-driving. Okay, and we don't have that. I mean, try driving around Pennsylvania. Their roads friggin' suck, right? And they don't even have good lines on the roads to figure out where to stay in the lanes because they have some of the oldest interstates in the country. And until that gets fixed, you can't have self-driving in Pennsylvania, right? Because the car can't read that. Matter of fact, my car does terrible in construction zones where they put the white lines temporarily. It confuses the car about the lane. So I have to turn the self-driving off in the construction zones. So I'm saying, I don't blame the car for that. It's still, you can do this 10 years ago, but we got a long ways to go. And so I'm curious, I think that's why there's gonna be some skepticism about this robo-taxi announcement from Tesla, because I don't think the infrastructure, much less the technology, like electric vehicles. The problem is you can't charge the damn cars that you buy, right, outside of your home. And that's the barrier to the marketplace. Until you solve the infrastructure, the growth is gonna be mitigated. Yes?
Why would Tesla signal like price cuts before their earnings call?
Because their stock is dropping like a rock. And it's not just signaling earnings, they're literally cutting the price. Like over the weekend, you could buy a Tesla cheaper than you could on Friday.
Why not announce that all a little bit worse?
Well, whatever the timing is, marketing people can figure that out. But the problem is they're also going to announce, likely tomorrow, an inventory glut. Because that's the point. They've been cutting back their production. That's why they did a 10% layoff last week, because they can't build as many cars that people aren't buying. And that was my anecdote about Hertz. Like even the rental car companies aren't buying these things because nobody wants to rent the ones they have, much less buy new ones. So it's just really bad short-term demand signals. Now again, this is short-term. Maybe they're going to solve this all and figure it out. Even the EEO today suggests that. They're going to grow, but just not nearly as fast and not nearly as quickly, right? And I think that's what we're starting to see. And that's why we do bulls and bears, right? Because if nothing else, these are signals that help us think about what those growth rates are going to be, what the revenue is going to be, what the margins are going to be. And all these suggest lower growth and lower margins, and therefore lower spreads. So that's what you see with all this red cuts in the numbers. All right, Boeing. So we didn't get a chance to talk about your Boeing assignment a couple weeks ago, so I just want to briefly talk about Boeing here today. So we had to do an as-is on Boeing and then a bull-bear target. Okay? So you have numbers that probably look something like this. But the first thing you notice about Boeing is that when you took the data from Bloomberg and you put it into the model, the CFI did not balance. Okay? And so I chose Boeing specifically because I knew that that was going to occur. And we had to fix it. Okay? And so the easiest way to fix it is when the CFI doesn't balance, you look at your TFI or TII and see which of those statements don't balance. And what you would have found, it was the TFI that was the problem, which meant it's the balance sheet. Okay? Now, in the model data, what I've done over time with all the companies we've experienced in this class is as new income statements and balance sheets come out, whenever we see something new that a company has, I usually try to put it on the list. Okay? So with Boeing, what it practically means is there's just something that Boeing's accountants put on their balance sheet that previously we hadn't encountered in this class. And because it's not on our balance sheet in the model, our model doesn't balance. Okay? And by the way, this is beyond this class, meaning I have some students who still use this once they graduate, and the same thing would happen. Like if they did Boeing on an older model, they'd have to fix the model. Or you're going to run into this in the real world. Like you're going to be getting data from sources, and you're in a finance job, and your data changes in some way. You have to figure out a way to adjust the new data into whatever model you have. Okay, and that's one of the parts of this assignment you had to do. So basically, you figure out what is off. You usually look for that amount. It clearly was something called deferred compensation. Now, I did make this a little easier for you because the last row in the data model I gave you at the beginning of the semester included deferred compensation, okay? But the only difference is it wasn't hooked up to anything, okay? So ideally, you would have figured it out what it was. You would have put in your export, which I'd already done for you, and then you hook it into your model. And so specifically, you'd go over your balance sheet, you'd go to other long-term liabilities. At the end, you add model data C80, which is the deferred compensation, copy that across, and then everything starts to balance again, okay? But that's another key point of why balancing models are actually a good thing. Because when the models don't balance, you know that there's a problem with your model. If you don't worry about trying to balance both sides of your model, you have no idea that this was a problem, and you would have left this off of a real balance sheet. Now, it's a relatively trivial amount, probably wouldn't have made a big difference, but nonetheless, there would have been an error in your model if we didn't balance the balance sheet and we kind of ignored this, right? So I know it's a pain to do this balancing, but I'm telling you there are benefits, and this is one, because it tells you when things are awry. All right, so assuming we did that, we then continued to update. All right, make sure the last reported year was 23. At the time, my WACC was 9.4, shares out 610.1. My share price at the time of valuation was 169.04. Data from the EEO for revenue, EBITDA, and multiples. Ratios, we need a tax rate. We need a realistic tax rate. The one that matters the most is column M. This tax rate matters most because this is the perpetuity tax rate. Okay. But nonetheless, what are they going to do in the future? Boeing didn't seem to provide guidance, so I used JP Morgan. And if the analyst report doesn't work and the guidance doesn't work, we still have to come up with one. We need a tax rate for the company, 17% in this case. I put a 3% growth rate in 2029. And on assumptions, perpetuity margin 8.72 to 8.4, I actually ended up with an EBITDA that gave me 8.76. I'm in the middle of the range. I'm not at the top of the range. Now, in previous assignments in class, I was closer to the top of the range. I'm in the middle of the range because of Boeing's manufacturing challenges, right? So Boeing is having all sorts of quality and manufacturing issues, and they haven't fixed them yet. Matter of fact, last week, they fired their entire senior management. They put in a new CEO who's supposed to fix the quality. The quality seems to be getting worse. They just fired him, and they're now looking for another leader to come in and basically fix the company, okay? And I think that that's going to take a while. And so I'm starting to even put my as is with the assumption it's going to take a while, all right? By the way, the root source of Boeing's problems today is a competitive issue in the market, okay? It's the root source of their problems today was an EIC issue, right? So just for your own benefit, there's a great Netflix documentary on this, if you haven't seen it. I think it's called Downfall, right? But what ended up happening is their problems started 10 years ago, okay? And the problem was this, that at the time, the airlines were buying these super jumbo jets, think A380s, that would have 550 to 600 passengers in them, dual-deckered planes. and they were using them to fly to these big international hubs. Okay, and that was the future of the airline industry. Except two things happened. One, when they got these super jumbo jets, fuel costs started to rise. And 20 to 25% of an airline's cost is fuel. So higher oil prices made these super jumbo jets unaffordable because they weren't very fuel efficient. The other problem is discounting. Those planes have to be full every day. So to fill a 600-person plane, they were having to discount the fares to fill every seat. And that was kind of subverting the whole idea that we'd have premium prices in a full plane, because they weren't having full planes, so they had to discount the prices and pay higher cost to run them because fuel was going up. So it made these big planes unaffordable. So the airline industry decided to shift. And what they shifted to were smaller planes, much more fuel efficient, that could fly international routes. Specifically, they stopped buying the twin aisle planes and they bought single aisle planes. So instead of 10 seats across, it was 6 seats across, right? So the idea is, I want to take a 737 and fly from Dulles to Paris, okay? I don't want to take a big plane Dulles to Paris, because if it's a smaller plane, it's more fuel efficient, it's not as heavy, it's just weight, drives fuel. And the other part is that I don't have to discount as much because it's 150 passengers, not 600 passengers, okay? And I can charge higher prices. So they started looking for smaller planes that could fly international long routes. The problem is, the 737 couldn't do that. It was never designed for international long distance flights. Couldn't fly that far, okay? And Boeing's competitor, Airbus, had just launched a plane called the A321neo. And what was interesting about that plane is it was light. It was not made out of aluminum, which was heavy. It was made out of composite material, almost like plastics, which made the plane very light, which means it was much more fuel efficient, and their engines were super fuel efficient that could fly very far. So you could fly an A321neo from DC to Paris nonstop without refueling. And Boeing did not have a plane that could do that. And so overnight, people were switching from buying Boeing planes to buying Airbus planes. And so Boeing had to do something. And so there were two choices. Choice number one, spend billions of dollars in 5 years designing their own version of the next gen plane to compete with the Neo. Choice number two, jury rig the 737 to fly long distances. Which choice do you think Boeing chose?
Number two.
They chose number two, okay? And so what they did is they went to the engine manufacturers and they said, can you design an engine that is fuel efficient, that can fly international on a 737? And they did. The engine makers actually came up with the engines. The problem is these engines were so big that when they put them under the wing, the engine would hit the ground on takeoff and landing. So they were too big to fit under the wings of the 737. Because the 737s were designed in the 1970s. Like, go back and look at some of the original startup pictures of Southwest Airlines. They were one of the first buyers of the 737. The engines look like toothpaste tubes. Okay, they're very tiny because the plane itself was built low to the ground, and it was low to the ground because it was easy for the ground crew to offload the luggage and to load the luggage. You didn't need a ladder, okay? And every generation of 737s, the engines got bigger. Well, in the latest generation of the MAX, they got so big they wouldn't fit under the wing. But then the Boeing engineers, geniuses that they are, came up with a solution. We're going to put these two struts and we're going to put the engines in front of the wing. Okay? So the 737 MAX, the engines are actually in front of the wing rather than under the wing, so they don't hit the ground. But that caused another problem. It made the planes unaerodynamic and very difficult to fly. Okay? So think about it this way. If you're going down the highway at like 70 miles an hour in your car, and you roll the window down and you put your arm outside the window, what happens to your arm? It starts doing this. Okay? Well, that's what was happening to the 737 MAX. Like when the 737 MAX was flying, because it was unaerodynamic with the wings and the engines not aligned, it was actually making the plane go herky-jerky and kind of pull up. But then Boeing came up with another solution. They said, aha, we've built military jets, the F-117 stealth bomber, which that stealth bomber was so unaerodynamic, like pilots would literally crash the plane if they flew it themselves. So basically they had to come up with software to fly by wire and fly the planes itself. It auto-corrected for all the problems with aerodynamics. And they said, we can take a version of that software and put that in the 737 MAX. And that software was called MCAS. And what the MCAS did is it basically auto-adjusted so that the plane would always stay in level flight without the pilots having to intervene. Okay? And then Boeing made another fateful decision. They didn't tell the pilots about the software. And they didn't tell the FAA about the software. And they didn't tell the airlines that the software was there. Because if they did, then that would involve a whole new generation of plane, which would mean everybody needed lots of training before the plane could go into service worldwide. By not telling them that it was just this feature of the plane, they could basically use the exact same pilots flying the previous generation plane, fly the new planes, and all of their training occurred on an iPad, and you could fly it the next day after reviewing the iPad. Because otherwise the plane didn't change much, right? So here's the problem. They also made another fateful choice to save money, where they had two sensors at the front of the plane to basically tell you how high the plane was flying and what angle it was flying at. So I'm going 270 degrees at 22,000 feet. Okay. So the point was they took out one of the sensors because like, why do we need two sensors? We'll save money. We'll just use one sensor. So on a very fateful day, 6 months after the 737 MAX launched in, I think it was Ethiopia, two pilots climbing through 8,000 feet experienced an error in the MCAS software. And what ended up happening is the software thought the plane was climbing when it was actually in level flight. So to adjust, it put the plane back in level flight, but what it actually did is it sent the plane into a dive. So the pilots are flying at level flight, hey, we want to climb to our next altitude, and all of a sudden, plane just lunges down towards the ground, straight down to the ground. And then they're pulling up, and they get it back to level flight. But when they got back to level flight, the software is like, no, 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 you're not at level flight, you're climbing again. I need to put you in level flight, put them in a dive. Fight, fight, fight. After a few minutes, this is all in the voice recorder, the plane is just plunging to the ground at 600 miles an hour, all to their deaths. And a couple seconds before the death, one of the pilots, you can hear on the recorder, says, what's that rattling sound? And the rattling sound was the software controlling the adjustment for the throttle, or whatever it is, the altitude, to move it up or down, that they didn't know it existed. And before they could disable it, they all crashed and they died. And so then Boeing, which knew this happened, they were doing an investigation. But they didn't tell the NTSB about the software. They didn't tell the pilots about the software. They didn't tell the airlines about the software. And someone in Boeing did an analysis that said this is like a 1 in a million event. So before we fix this, we probably will fix it before anybody even finds out about it, so we're not going to tell anybody. And then a few months later, two pilots flying out of Indonesia, same exact circumstance. They got to about 8,000 feet, software malfunctioned, another bunch of people died, 350 people killed in a matter of 6 months. And that's when they copped to, oh, by the way, there's this software in here that we didn't tell you about that's a problem, okay? And that's was the start of the problems with Boeing. They had to fix every 737 MAX worldwide. By the way, you know what the fix was? To make it safe to fly again? They trained the pilots on the software. So the plane today is still unaerodynamic and prone to having problems. But basically, when it does have a problem that the software can't solve for, the pilots are trained to turn the software off and take manual control. Okay, that's the fix. Okay, enjoy your travels in the 737 MAX. But in any event, but then it got better. Because while they're doing this, Boeing had outsourced, remember I told you Siemens Energy had outsourced a bunch of windmills that wobbled, okay, because they didn't fit well because their suppliers didn't do good fit checks with each other. Boeing's had the same problem with 737 MAX. So they outsourced to their suppliers who didn't supervise well, and they didn't put the plane back together very well. So for example, that's why a few months ago, one of the windows blew off the side of the plane because it wasn't put fitly into the plane, okay? And that's another manufacturing issue they're dealing with today. And then they had a whistleblower come out a couple weeks ago who said, oh, by the way, they're having lots of problems with their 787s, right? Now, right now, the market doesn't know whether that's true or not. But the whole point is Boeing is having lots and lots and lots of problems. I say that because that's the concepts, things you need to think about for your bull and your bear, okay? Those are the issues. Because it's not just a market issue, it's a company issue. And if they can't get out of the way of these quality problems, it doesn't matter how well they do, they're going to struggle to do well in this good marketplace. All right? And by the way, if you look at the orders, as I said a couple sections ago, the teams did the airline industry, and one of the teams was doing Southwest Airlines. Part of their bull in their bear is Southwest had bought a bunch of the 737 Maxes, and Boeing's not delivering them. Because of their quality issues, they've had to slow down their manufacturing. And so people can't actually get the 737s that they were promised, so they've actually had to cut back on their growth plans and cut routes because they can't actually get the planes to fill them. United did the same thing. United was a big buyer of the MAX. Now they're not buying nearly as many MAXes, and they're actually calling Airbus and saying, can we have your A321neos because Boeing can't deliver these MAXes because they're under production constraints because of quality. And a week or so ago, they fired their entire leadership, including the CEO, because they haven't fixed their quality issues. And they're now bringing in new people who are quality first. Now, don't get me wrong, I think that's a good idea. Like, I fly a lot, and I don't want to die in a plane crash because of a production issue that Boeing is having. And they've had a pretty good safety record over time, for the most part. I'd like them to get back to that. But if they spend more money on safety, what's going to happen to these margins? They're going to be down. And if they take longer to deliver the planes because they want to make sure they're right, some of these sales forecasts could go down. So as I said, this actually plays over into your bull and your bear for the company. These become really important issues. And that's why when I did my bull and my bear, and I'm not going to do it here today, but I actually think there's more downside risk than upside risk to Boeing, right? Because if nothing else, we do our as is. You can see in the EO, they're expecting almost an 8% growth, 7% growth rate long term. That's a very high growth rate, right? But if they can't grow because of their manufacturing issues, then that's what's going to be under threat. And if they end up growing even at 5% a year, you can see what that does to their share price. Okay? So what I'm just saying is, I think that there's not too much more upside in Boeing right now, for reasons I just said. I think there's actually more downside risk, right? And then we do our sanity checks. So we do our sanity checks. I'll undo this, go back to our as is. What's interesting is these are, and I'll focus on EV to EBITDA, these are the multiples. Last year, next year, 2 years from now, right? Industry average EV to EBITDA 2 years from now is 12.68. That's F3, okay? Boeing is at 16 and 17 in our model. So the point is, Boeing's already got the highest EV to EBITDA across all the years, right? So they're much higher than industry average. That's the as is. So if I'm going to do a bull, they got to do even better than that. You know, are people going to start paying like 25, 27 times EV to EBIT in an industry that's, you know, the highest firm right now is Boeing at 16? So I'm just saying, I think when you start to do the sanity check, you start to see that the upside is kind of limited. And the downside is there's a lot of companies trading at 10 to 12 times EV to EBITDA. And if they continue to have manufacturing problems that look more average, they could easily start trading in that range. So I just think that there's some validation that there's more bear risk than bull risk, even by the multiple analysis that we would do as a sanity check, right? And then where do you think you end up as Boeing? My personal opinion, they're a hold sell. They're either hold or they're sell. I'm not pessimistic. I'm more pessimistic on the future, just because there's pretty optimistic numbers even in their numbers today. And given all the problems, I think it's going to take a while to get it fixed. Okay. Now you can be a contrarian. You can say no, they're going to fix it. They're going to surprise everybody, and things are going to go great. And now's a good time to buy because there's been a sell-off in the stock. There are people who say the same thing about Tesla. Like, Musk is going to save the day. He's going to have all these things that fix the company, and suddenly he's going to go back on that growth track. And there's people who believe that, right? And we'll see in the next few years, looking hindsight, but that's the point. We have to at least think about these things as we're making our judgments. So that was your Boeing assignment. Questions about that? Yes?
So, for example, Boeing, when we pulled out the multiples, there were a lot of NAs for some of the multiples.
Yes, especially on the PEs.
Yeah. What would be your recommendation in that case if the company
Well,
had a lot of
I mean,
misalignments?
the reason why, for example, a PE would have an NA is because usually they don't have earnings, right? And so if you don't have earnings, you can't have a multiple because it's price to earnings, no earnings, there's no PE. So unfortunately, they're there, but you have to kind of, you know, go past that. That's Boeing's problem, for example, here, right? They have an NA for the historical numbers because, you know, price divided by negative earnings is a negative PE, which wouldn't make sense, right? So therefore, you can't use that as a comp for a company. And you have to either ignore them, treat them like they don't exist, and use the other companies in the industry, or find other peers to put in your analysis. So when you do your group project in 2 weeks, my recommendation to you, don't choose a company with a bunch of missing multiples and a bunch of NAs. You're just gonna have a hard time explaining that, right? I'm giving you the opportunity to pick 2 companies that are peers, pick the easier peers to do the analysis on, right? And that's just the short version, right? Now you wanna try the more complicated stuff, it gets more complicated, all right? And that's part of the analysis that we're gonna do in your next assignment, okay? So this week's homework I considered easy. Next week's multiples will be harder, okay? Because I'm gonna give you a company that has problems, and you're gonna have to figure out how to do it, okay? So just warning you in advance. Also, I'm gonna let you know that Wednesday is a Bloomberg Lab day, okay? So there's no lectures. I don't need to give you any more content. We're just applying stuff. You know how to do this stuff. So I'm gonna give you the day Wednesday to get the data to do the assignments. I'd also recommend meeting with your teams on Wednesday and starting to see who you might want to select as peers for your group project, which is coming up 2 weeks from today. So a lot of stuff happening at the end of the semester. Take advantage of that. And here's why that's important. So for this assignment, I made last Wednesday a Bloomberg Lab day to get the data, and I gave you the multiples assignment 2 weeks ago. And I had people email me on Sunday and said, Professor Perfetti, can I have an extension? I didn't have time to go get the data from the lab, right? My answer to them, no. Okay, because I gave you 2 weeks to work on the assignment. I gave you a day in class to get the data, and you chose not to do that. And this weekend, you're finally like, I'm getting around to doing it, and the lab's closed. I'm not going to give you an extension. So the same is going to apply for this assignment, right? I'm giving you a lab day. There's almost no reason, unless something's really bad happening to you or your family, that you need an extension for homework 13. You shouldn't need one. So don't ask for one. All right. All right. So let's talk about multiples. Homework 12. So 3 companies. McDonald's, Starbucks, Chipotle, all right? Part of the reason why I said this was going to be an easier assignment is because of the nature of how we do the multiples, okay? So just as a reminder, math-wise, when we set up our valuation model, most of the valuation of any company is this cell, it's D9 in the valuation tab. It's the perpetuity DCF. Okay? The value's not in the first 5 years, the value's in the perpetuity. And the perpetuity is the key value driver equation. So we want to get that right. Okay? And if we don't get that right, we're going to have trouble valuing any company. Okay? And getting that right means getting these 4 assumptions right. Because these are the 4 assumptions that make up KVD. Okay? And so the whole point is, if we're doing a DCF, and year 6 arbitrarily is not representative of the future, then you're going to have trouble with your continuing value. And we have to put in things that really represent the future, because that's the whole point. That 4 numbers represent the future on average for the company. Well, when you do a multiples assignment, it's the same thing, except we're not doing 5 years first before we do the future. We're doing the future from today. So we're doing the future for the entire future of the business from today using key value drivers. Those 4 numbers represent the future. So they need to be representative. And if they're not representative of the future, then we need to put things that are representative, right? And that's why I told you this assignment would be easy, because McDonald's, Starbucks, Chipotle are kind of like Costco. Like, these companies are not anticipated to have problems in the future, right? The business models are pretty straightforward, like plus or minus a little bit, but we kind of know how they're going to do, and tomorrow looks a lot like today. So it makes the companies easier to do, right? Now, if I gave you Boeing to do the multiple analysis on, that's a little bit more challenging, because you got to figure out how long it's going to take them to fix their problems. Let's assume that they do. I assume that they have good intent, good people, they'll figure it out. How long is that going to take? And what are they going to look like when they fix the company? Well, that's a much more difficult prospect for a multiple analysis, because I'm not doing 5 years. I got to figure that out today and balance that out. So even 2 years out, I don't think Boeing's going to fix all their problems in the next 2 years. Makes the multiple analysis more difficult. I don't think Tesla's going to fix all their problems in the next 2 years. Makes their multiple analysis more difficult than if we did it today. So just remember that when you're doing this assignment, okay? This assignment I called easier just because these companies, not expected to have issues, they have successful business models, and they probably are going to stay consistently successful expected in the future. There's nothing that's dramatically different in their valuations. So therefore, today looks a lot like tomorrow. Now the issue then becomes, we have to forecast to do ROE. I'm going to switch this to McDonald's. That represents perpetuity. Okay? And so here is McDonald's. And you look at these numbers and you're like, WTF? Like, this doesn't make any sense, right? And so then it became like, why are these big negative ROEs? And they're big negative ROEs not because they're losing money, they're negative ROEs because they bought back a bunch of stock and it wiped out the book value of their equity. So the balance sheets are kind of screwed up. And so we have to estimate an ROE, right? So the question is, how do we do that, right? And so I think the TA sent out a very helpful announcement over the weekend, which is something I addressed verbally in class last Wednesday. Announcement. And he basically gave you this little Excel file to kind of help you out, which that Excel file was this Excel file, okay? And this is what I was telling you in class on Wednesday, which is, if you think about ROE and ROIC, like the formula for ROIC is P over I, profit over investment. That's ROI, okay? And the formula for return on equity is P over E, okay? And so the question is, how do you get from P over I to P over E algebraically? And the answer is you multiply by I over E and the I's cancel out, okay? But what that tells me is that what connects return on invested capital to return on equity is this I to E ratio. That is known as your leverage ratio, okay? Because investment, simplistically, is debt plus equity, okay? So if I take debt plus equity and divide by equity, the debt plus equities cancel out, and I'm left with return on the equity, okay? So it's how much debt plus equity relative to equity, how much debt and equity do we have, is really the difference between the ROIC and the ROE, okay? Now that is oversimplifying this correlation for a couple of reasons. Number one, the P in ROIC is NOPAT, and the P in ROE is net income. And NOPAT and net income are not the same thing. Debt plus equity is what I'm using here for invested capital, but remember that that includes operating and non-operating capital together. And we take out non-operating items. So that could also affect this ratio, the non-operating capital. So assuming there's no non-operating items and assuming the NOPAT and net income are similar, this works out perfectly. But that's not the way the real world works. So I said it's loosely based on the ratio, but nonetheless, you at least do a starting point. So here's the idea. Last year, McDonald's ROIC, 22.6%, stable business. Look at the wax screen, 20% debt today, 80% equity. That suggests a 28% ROE for a 23% ROIC, okay, approximately. So my number for McDonald's is probably somewhere around 28, plus or minus a little bit. Same thing, Starbucks, same issue, 26% ROIC, 18% debt, 82% equity. That works out to be about a low 30s ROE, okay? So this is just kind of saying, if we take out the accounting distortions, this is more realistic about the type of equity balances and the ROEs they have in the firm. Questions about those adjustments that you would have had to make? Okay, because that's every now and then something you're going to have to run into. And there's nothing we can get around. That's why, by the way, EV to EBIT and EV to EBITDA, EV to revenue multiples are preferred. I told you, because PEs can be the most distorted because PEs are most subjective to these accounting issues because it's based on book value of equity. And book value of equity is manipulated. Lots of problems with it, okay? So that's the issue, right? So nonetheless, we still have to come up with it. So we have to come up with a PE, so we have to make this type of adjustment. The other adjustment that you're going to run into, okay, is our process adjustment. The process adjustment I want to make you aware of, because you might have to do something differently on your next assignment, hint, hint, is when you put in the multiples, our process is basically to put in everything else and solve for a G, right? And the simple idea is that spreads are easier to predict, and so therefore we know the spread, solve for the growth. But every now and then, the spreads are not going to be easy to predict. Let's go back to Boeing. Like, what is Boeing's long-term spread? The next couple of years, as they're fixing the company, that may not be representative of their long-term spread. So what is the long-term spread when they fix the problems? It might take more than 2 years to get there, right? So here's the point. Sometimes what you need to do is put in a growth and solve for the spread. So our process so far this semester is to put in the spread, solve for the growth. But when that doesn't work, the other way to do it is to put in a growth rate and solve for a spread. So for example, if I did a 5% G for Boeing and then solve for the ROIC using GoalSeek, that gets to my multiple. That's a different way of doing it than put in a spread, ROIC, and then solve for a G, okay? So you can go either way. And usually we like to go the way we've done because G's are very sensitive. But if we don't know the spread, G's can help us figure out the spread. Okay? So it's just another thing to think about when you're doing your valuation. And I'll pause. Does that make sense to everybody? Why you do that? Yes, sir.
How'd you figure out your G?
That's the fun part. So let's say we're doing Boeing. Like, what is a reasonable G for Boeing for their long-term future? Well, that's a harder number to get, but nonetheless something we'd have to try and understand. So how do you choose 5% or 6% or 4% or 7%? That's what we'd have to figure out. That's why I don't like doing that process. It's just harder, right? But even though it's one number, like how do you figure out what that long-term growth is? Because I got to balance the growth with the mature stage with the potential decline stage. So I need an average that kind of represents it all. That's actually why we don't like to do this with growth companies, because I got to balance a growth with a maturity. And so the G is going to be somewhere between the two, average of the two. So if I'm mature, then it's easier. And when I'm mature, most companies tend to grow 2 to 3%. So I want to be at a mature base where I'm in that 2 to 3% range, kind of growing with the market, and then the spreads become easier to predict. Boeing is having a little bit of challenge because people still expect Boeing to grow much faster than the economy because people are still growing commercial airlines very rapidly, right? So they, if they fix their problems, will be able to continue that growth. They got a lot of orders. And again, like Siemens Energy, the market expects them to fix the problem, right? It's just how long it's going to take them to fix the problem. So here's the idea. For Boeing, I think that's going to be a higher G than 3%, just how much higher, okay? And so, again, that's where you're going to have to make some educated guesses and assumptions. But that's why I call that one a much more difficult assignment than Costco, okay? Or even these three companies. Does that kind of make sense? Okay. Notice I didn't give you a final answer because there isn't one. All right, so back to this. McDonald's, 8.5% cost of equity. Start filling in the rest. From our little spreadsheet. Where is our spreadsheet? Should be files open. McDonald's, we had estimated, there it is, about a 28% ROE, so 28.25. Okay. And while I'm here, for Starbucks, 32.44. Which means for EEO, second year, EV to revenue 15.04 and 13.98. And sorry, EV to EBIT 18.49. And for the second year net income, $95.50. Here's And the PE in the second forward year was 20.47. So with these adjusted numbers, we can goal seek. So I'm going to set this to 24/7 by changing my G. And that's going to get me about a 4.37% G. Okay. Do you have numbers somewhere in the 4.37 range? Yes? Okay. Sorry, what was your name? Yeah, Matt Dillon? Thank you. All right, so thank you, Matt, for volunteering. So I'm going to go to the assignments. And these have not been graded yet. But if we go to homework 12, there we go. And if I go, oh, some have been started to be graded. TAs are efficient today. So I'm going to look at the assignments that were turned in. And I'm going to go to our volunteer, Matt. Where is he? Dylan, D-I-L-L-O-N?
G-Y-L-A.
Oh, that's probably.
You're on the
Oh, I'm in the wrong section. This is section 301. Good one. The hell? Where are you in here? You're probably on this list somewhere. I don't know why it's not in alphabetical order.
Professor, you can just use mine. It's already pulled up.
Yours is already pulled up?
Yeah.
Okay. Did you get approximately that number?
Yeah.
Okay.
If I remember correctly.
All right. So thank you for being our volunteer. All right. Yeah, you're in that range. And I'm just saying, if you're in that range, I'm guessing you're probably in a good range for the other two without having to do the full assignment. So I'm assuming these numbers are probably directionally correct. Do other people have numbers that look similar to this for the G's? Okay, so good. So you're probably in a good shape. So here's the idea. Now we go to the next step, we got to explain, right? Why premium or discount? And so for McDonald's against Starbucks, all right, McDonald's is trading at a premium to Starbucks in the PE. Why? Well, first thing we notice, the growth rates of McDonald's and Starbucks are somewhat similar, although Starbucks is higher at 4.6 versus 4.28. So slightly higher growth at Starbucks, right? That would suggest a higher multiple, which they don't have. Spread at Starbucks is higher than McDonald's. They're 33% spread ROE against a 9.2% cost of equity. Rounding off, that's about, call that 24 points. And McDonald's 28.7 minus 8.5, that's about 20 points. All right, so Starbucks has higher growth, higher spread. Well, that should mean a higher multiple. So the whole reason why Starbucks is trading at a discount, 18.7 versus 20.16, it's at higher cost of equity, 9.2 versus 8.5. Right? For Chipotle, Chipotle's got amazing growth. They're growing at double McDonald's and Starbucks, 8.37% a year, and they have the highest spread of the three, almost 44% ROE against a 10% cost of equity. That's a 34 points of spread. It's clear why Chipotle's trading at a premium at 44 times PE. Okay, it's all about their growth, right? Growth at high spread. And at the same time, they do have a higher cost of equity, so the multiple is somewhat mitigated by their higher cost of equity, but it's all about that high growth rate. That's what's driving Chipotle. Okay? And then you go over and you do the second multiples. Okay? EV to EBIT. Why is McDonald's trading at a premium to Starbucks? Well, similar things. Starbucks has a higher G, 4.6 versus 4.28. Starbucks has a higher spread, 27% ROIC against 8.4% WACC, 23% ROIC against 7.8% WACC. Starbucks does pay higher taxes, which should lower the multiple. Okay, so the one thing that's hurting Starbucks seems to be their tax rate, but the other thing that's hurting Starbucks multiple is the higher WACC, 8.4 versus 7.8. So it's really the higher taxes and the higher WACC, which is why Starbucks is trading at a discount. Why is Chipotle trading at a premium? Again, pretty straightforward. Chipotle has an 8.5% G, and they don't have the highest operating spread. They actually have the lowest operating spread, and they have the highest tax rate. So Chipotle is trading completely at a premium because of that high G, 8.5% versus 4.6 and 4.3 at the other peers, despite the higher cost of capital. And then we do EV to revenue, EV to sales. Generally, EV to sales is based on margin first, and McDonald's margin is almost triple their competitors. Why? And it's not because of the $18 value meal. Why is McDonald's making so much more money than, as a margin, 47%, 37% no pat, than Starbucks and Chipotle? Yeah.
Their scale.
It's not their scale. You'd think it was economy scale, but that's not going to explain the tripling. Yes.
They own the real estate, the restaurants.
The real estate helps them. They do own the real estate under the stores. But what don't they own? Yeah.
Because they're franchised.
They don't own the stores. They're franchise model. So McDonald's is different. This is an apple and an orange because McDonald's is a big franchise business, right? So basically, you go to that store on Highway 1, not too far from the University of McDonald's over there. McDonald's doesn't own that. There's a person or a company that owns that. And so what they'll do is somebody will buy like all the McDonald's in the district or the Maryland DMV area. And so but some franchisor will own 200 McDonald's, and then they'll pay McDonald's a bunch of licensing fees, buy the food from them, branding issues, but McDonald's doesn't own the physical stores, or they don't actually own the people. The people are hired by the local stores. So that's the point. McDonald's actually gets a much higher return because of the franchise model. And Starbucks tends to own their own stores. Chipotle tends to own their own stores. There's very few franchises. So that's the point. That's why McDonald's actually has a different multiple. And they really are different than the other two companies. And I wanted to illustrate that here. And you see that in the EV to sales. So the EV to sales for McDonald's is so much higher, 8.6 times EV to sales, because it's really a different business model. Right? I'm getting much higher margins because those franchise fees are almost pure profit to them in running their business at McDonald's, right? And so Chipotle and Starbucks, a little bit more traditional, they're more comparable, right? Why is Chipotle so much more valuable than Starbucks? Okay, despite the fact that they have similar operating margins and similar after-tax margins and similar ROICs, because Chipotle also has more franchisees than Starbucks. Starbucks has the most owned stores. And that hurts their EV to sales. And so that was the one complication that would have made this analysis a little bit harder. But if you skip that, then you should have at least tried to explain it with the numbers you see. And you could say that Chipotle's high growth rate would have been why their EV to sales is higher. That would have been your only other explanation if you didn't talk about the franchise model. Okay. Questions about any of this? Okay. So this is what you're going to be working on. One more practice homework assignment or final homework for next Monday. And as I said, pick 2 peers and start talking to your teams. Use class time on Wednesday to do that. There'll be no lecture on Wednesday. Our next live lecture, which is pretty much the last one of the semester, is next Monday. And then right after that, you're going to be doing your group projects. So, any other questions? All right, where's the sign-in sheet? Make sure you sign the sign-in sheet before you leave. Otherwise, go enjoy this beautiful day. See you guys next Monday.
Yeah.